Effective risk management is the cornerstone of successful trading, and no tool is as fundamental to this as the stop loss. It is not merely a mechanism for limiting losses, but a critical indicator signaling the invalidation of the initial trading hypothesis that a trader formed based on market analysis. In a world where emotions often overshadow rationality, the stop loss serves as a logical boundary that protects a trader's capital from unwarranted losses. It allows for the preservation of funds for future, more promising opportunities, instead of holding on to a losing position in the hope of a miracle that, as a rule, does not occur. Without a clearly defined stop loss, a trader exposes themselves to unlimited risks, which can lead to catastrophic consequences for their trading portfolio, potentially resulting in complete depletion. Richard Wyckoff, one of the pioneers of technical analysis, developed a comprehensive approach to understanding market structure based on the interaction of supply and demand, effort and result, and a meticulous study of market cycles. His methodology allows traders to read the actions of large professional players, whom he called the composite man, identify phases of accumulation and distribution, and anticipate future price movements with a high probability. Understanding Wyckoff's logic makes it possible not just to place stop losses at arbitrary levels, but to position them at logical points that define turning points in market dynamics, signaling a change in the market's fundamental structure. This transforms the stop loss from a simple price level into a strategic tool that reflects the invalidation of the initial market hypothesis. In this video, we will delve deeply into 10 stop-loss strategies that every trader should know based on the unparalleled principles of Richard Wyckoff. These strategies will help you not only protect your positions, minimizing losses, but also to understand the market significantly better, identifying logical points to exit a trade when the market moves against you. We will examine how to apply these principles to determine places where the market clearly invalidates your trading idea, allowing you to minimize losses and maximize potential profit by holding on to winning positions. Each strategy will be explained in detail, providing you with a clear understanding of its rationale and practical application in real market conditions. Prepare to expand your knowledge and improve your trading discipline. 1. Stop loss at the low of a selling climax or automatic rally in accumulation. A selling climax is an event where intense selling pressure reaches its peak, often manifesting through unusually high volume and a wide price spread downwards on a price bar. This indicates that many retail traders are panicking and selling their assets, often due to fear or forced liquidations, while large professional players, whom Wyckoff referred to as the composite man, are actively absorbing this supply. They are collecting shares from weak hands, capitalizing on market panic. A selling climax is usually followed by an automatic rally, which occurs due to a sudden decrease in selling pressure and an increase in buying interest, as supply is temporarily exhausted and buyers begin to dominate. These two events together form the initial lower boundary of the accumulation trading range, which is an important reference point for future price movements and indicates the first signs of a trend change. They mark the first indications of significant institutional demand appearing, which begins to halt the downtrend, forming a temporary equilibrium. The strategy for placing a stop loss for long positions, initiated after these events, involves setting it slightly below the lowest price of the selling climax or the lowest point of the automatic rally. This typically means placing the stop loss a few ticks or points below the actual low of the bar that formed the selling climax, or the lowest point of the automatic rally. This gives the price a small breathing room below these critical levels, accounting for potential short-term noise movements or false breakouts that could trigger stop losses. Such a stop loss placement is logical because these levels represent points where large players began actively supporting the market, absorbing supply. They are evidence of significant demand that should prevent the price from falling further if the accumulation hypothesis is correct. The rationale for this strategy is that a break below this level and sustained price consolidation below it indicates that the selling climax was not exhaustive, and the demand that was supposed to absorb it proved insufficient. This means that the initial hypothesis of accumulation and a potential trend reversal is incorrect, and the market is still dominated by supply. If the price breaks this level, it indicates that supply still dominates demand, and the market is likely to continue its decline. Such a move invalidates expectations for an upturn, requiring an immediate exit from the position to minimize further losses and preserve trading capital for other, more promising trades. It is important to understand that any break below this level is a signal to reevaluate the market situation. 2. Stop loss at the high of a buying climax or automatic reaction in distribution. A buying climax is an event that marks the peak of buying activity, when the market reaches its maximum on high volume and a wide price spread upwards on a price bar. This is often caused by the euphoria of retail investors who rush to buy, fearing they will miss out on further growth, often referred to as FOMO. At this point, smart money or institutional investors, who had accumulated positions earlier at lower levels, begin to actively sell their shares, utilizing the high demand from retail investors. A buying climax is followed by an automatic reaction, the first significant price decline after the peak of buying activity, indicating the emergence of significant supply. These two events together define the initial upper boundary of the distribution trading range, which is a key reference point for further analysis and signals the end of an uptrend. They indicate the emergence of significant supply that begins to halt the uptrend and form an equilibrium zone, with hidden potential for a decline. The strategy for placing a stop loss for short positions, initiated after these events, involves setting it slightly above the highest price of the buying climax, or the highest point of the automatic reaction. This typically means placing the stop loss a few ticks or points above the actual high of the bar that formed the buying climax, or the highest point of the automatic reaction. This gives the price a small breathing room above these critical levels, accounting for possible short-term noise movements or false breakouts that could trigger stop losses. Such a stop-loss placement is logical because these levels represent points where large players began actively selling, forming resistance to further growth. They are evidence of significant supply that should prevent the price from rising further if the distribution hypothesis is correct. The rationale for this strategy is that a break above this level and sustained price consolidation above it indicates that the buying climax was not a true sign of distribution, and the demand that should have been exhausted proved stronger. This means that the initial hypothesis of distribution and a potential trend reversal is incorrect, and the market is still dominated by demand. If the price breaks this level, it indicates that demand still dominates supply, and the market is likely to continue its growth. Such a move invalidates expectations for a decline, requiring an immediate exit from the position to minimize further losses. This confirms that the bullish trend is still strong, and any attempt to short the market would be unjustifiably risky. 3. Stop loss below the low of a spring or shakeout in accumulation phase C. A spring or shakeout are critically important events in accumulation phase C, representing the last and most insidious bear trap before the start of an uptrend. These events are characterized by a brief, but often sharp, break of the support level of the trading range, creating the illusion of a continuing downward movement. The purpose of such moves is to shake out weak holders who are holding long positions and to trigger their stop losses, which are usually placed below support, as well as to attract new sellers. Large players use this maneuver to accumulate as many shares as possible at lower prices, exploiting panic or forced sales, before initiating a significant upward move. Typically, after such a break, the price quickly returns back into the range, which confirms it was a trap, not a genuine downside break, indicating supply exhaustion. The strategy involves placing a stop loss slightly below the extreme low of the spring or shakeout. This gives the position a small amount of breathing room, taking into account possible micro fluctuations in price or short-term spikes below the level. This low is crucial because it represents the lowest point to which large players allowed the price to fall to gather liquidity before pushing it back up, demonstrating their strength. This is a kind of point of no return for the accumulation hypothesis. If the market is indeed ready for an upturn and the spring was a genuine trap, it should not return below this level, as this is where smart money bought up the last significant supply, and a further decline would indicate a different market dynamic. The rationale for this strategy is that a break below this low and the inability of the price to quickly recover back into the trading range indicates genuine market weakness rather than a trap. This means that the spring or shakeout were not successful traps, but rather a genuine break of support, which indicates the continued dominance of supply. Such a development invalidates the potential accumulation and points to continued downward pressure, possibly even the beginning of a new distribution phase or a continuation of a bearish trend. In such a case, holding the position would be an unjustified risk, and exiting with a loss is a logical and disciplined decision to preserve capital and minimize further losses. 4. Stop loss above the high of an upthrust or upthrust after distribution in distribution phase C. An upthrust or upthrust. After distribution are bull traps that occur in distribution phase C before the start of a downtrend. These are false breakouts of the resistance level of the trading range, designed to entice late buyers who believe in the continuation of the uptrend, often based on old news or euphoria. Large players, who have already accumulated their positions at lower levels and are now looking to sell, use these moves to create an illusion of market strength and attract liquidity. They allow the price to briefly rise above resistance to trigger buy orders, and then sharply reverse direction downwards, selling their shares to these late buyers who find themselves trapped. This is a key signal that supply dominates, and the market is ready for a decline, indicating that the upward movement is exhausted. The strategy for placing a stop loss involves setting it slightly above the extreme high of the upthrust or upthrust after distribution. This gives the short position a small amount of breathing room, taking into account possible micro fluctuations in price or short-term spikes above the resistance level. This high is critical because it represents the highest point to which large players allowed the price to rise to attract sufficient liquidity for their sales before pushing it back down, demonstrating their dominance. This is a kind of point of no return for the distribution hypothesis. If the market is indeed ready for a decline and the upthrust was a genuine trap, it should not return above this level, as this is where smart money sold off the last significant demand, and further upward movement would indicate a different market dynamic. The rationale for this strategy is that sustained price action above this high after an upthrust or upthrust after distribution indicates the failure of the distribution. This means that the upthrust was not a successful trap, but rather a genuine breakout of resistance, which indicates the continued dominance of demand. Such a development invalidates the initial idea for a short position and points to continued upward pressure, possibly even the beginning of a new accumulation phase or a continuation of a bullish trend. In such a case, holding a short position would be an unjustified risk, and exiting with a loss is a logical and disciplined decision to preserve capital and minimize further losses. 5. Stop loss upon price returning into the trading range after a breakout of the upper boundary, accumulation. After a period of accumulation characterized by sideways price movement within a trading range, the market often shows a breakout of the upper boundary of this range, known as a jump across the creek. This breakout is an important signal that can indicate the beginning of an upward phase, where demand finally overcomes supply, and the composite man is ready to push prices higher. Traders expecting an upward move often open long positions precisely on this breakout, hoping for a continuation of the trend and significant growth. However, it is important to be cautious, as not all breakouts are genuine. Some turn out to be false, or as Wyckoff calls them, upthrust action, or spring action in reverse. This means that the price may briefly move outside the range, but then quickly returns back inside, signaling a lack of genuine strength. The strategy for long positions opened on such a breakout involves placing a stop loss if the price fully returns and stabilizes within the previous trading range. This could be a level slightly below the upper boundary of the range, or even within it, depending on where the price shows signs of stabilization and a lack of new upward momentum. It is important to distinguish a short-term pullback, which could be a test of the broken level, from a genuine return that invalidates the breakout. The stop loss should be activated when it becomes clear that the breakout has not received support, the price has lost momentum for further upward movement, and sellers are regaining control. This allows the trader to quickly exit the position if the market does not confirm the expected upward move, minimizing losses. The rationale for this strategy is that the price returning back into the trading range after a breakout indicates a false breakout, or that the initial breakout was a trap. This invalidates the expected upward movement and points to the persistence of equilibrium conditions or even hidden weakness if the composite man was unable to hold the price higher. If the market cannot sustain itself above the broken level, it means that demand is insufficient to support a new trend, or that supply proved to be significantly greater than expected. Instead of moving up, the price may continue sideways or even reverse downwards if it was a hidden upthrust leading to distribution. Such a scenario requires an immediate closing of the position to avoid significant losses. In the world of trading, where every decision carries the weight of gold, knowledge and understanding are your most valuable assets. We have just examined 5 key stop-loss strategies based on Wyckoff's profound principles, which help protect your capital and act logically, not emotionally. These methods allow you not just to react to the market, but to anticipate its movements, understanding the fundamental reasons behind every price action. However, mastering these strategies is only the beginning. What if you want to delve even deeper into the source of this knowledge? What if you aspire to master Richard Wyckoff's complete philosophy, not just to follow individual strategies, but to understand the market at an intuitive level, to see its structure, and to anticipate the intentions of large players? Precisely for this purpose, there is the book, How I Trade and Invest in Stocks and Bonds, an adapted edition of the classic work by Richard Wyckoff himself, one of the most influential pioneers of technical analysis. This is not just a book, it is your personal mentor, revealing time-tested market analysis methods that remain relevant for decades, despite changes in trading technologies. In it, you will find not only the basics, but also the subtleties of determining the intentions of large players who are behind every price and volume movement. This work will teach you to see the market through the eyes of professionals, to recognize phases of accumulation and distribution, and to make informed trading decisions based not on emotions, but on a deep understanding of the dynamics of supply and demand, effort and result. If you are serious about success in trading and wish to transform your stop-loss knowledge into part of a comprehensive, systematic, and profitable trading system, then this book is your next logical step. It will help you systematize your understanding of the market, teach you to identify key moments when professionals enter and exit the market, and ultimately make you a more confident and profitable trader, capable of independently analyzing any market. Do not miss this unique opportunity to gain access to the wisdom of one of the greatest traders in history, whose principles have stood the test of time. Find the link to How I Trade and Invest in Stocks and Bonds in the description below this video, and begin your journey to mastery today. This is not just a book purchase, it is an investment in your knowledge and future success that will pay off many times over. 6. Stop loss upon price returning into the trading range after a breakout of the lower boundary. Distribution. After a period of distribution, when large players are actively selling their assets, utilizing the demand of retail investors, the market often shows a breakout of the lower boundary of the trading range. This breakout is an important signal that can indicate the beginning of a downward phase where supply finally overcomes demand, and the composite man is ready to push prices lower. Traders expecting a downward move often open short positions precisely on this breakout, hoping for a continuation of the trend and a significant decline. However, as with upward breakouts, It is important to be cautious and critically evaluate the situation. Some of these breakouts turn out to be false, or as Wyckoff calls them, spring action or upthrust action in reverse, which is a trap for sellers. This means that the price may briefly move outside the range, but then quickly returns back inside, signaling a lack of genuine weakness and exhaustion of supply. The strategy for short positions opened on such a breakout involves placing a stop loss if the price fully returns and stabilizes within the previous trading range. This could be a level slightly above the lower boundary of the range, or even within it, depending on where the price shows signs of stabilization and a lack of new downward momentum. It is important to distinguish a short-term pullback, which could be a test of the broken level, from a genuine return that invalidates the breakout. The stop loss should be activated when it becomes clear that the breakout has not received support. The price has lost momentum for further downward movement, and buyers are regaining control. This allows the trader to quickly exit the position if the market does not confirm the expected downward move, protecting them from potential significant losses that can arise from a reversal. The rationale for this strategy is that the price returning back into the trading range after a breakout indicates a false breakout, or that the initial breakout was a trap. This invalidates the expected downward movement and points to the persistence of equilibrium conditions or even hidden strength if the composite man was unable to push the price lower. If the market cannot sustain itself below the broken level, it means that supply is insufficient to support a new trend, or that demand proved to be significantly greater than expected. Instead of moving down, the price may continue sideways or even reverse upwards if it was a hidden spring leading to accumulation. Such a scenario requires an immediate closing of the position to avoid significant losses. 7. Stop loss based on Wyckoff's law of effort versus result. Double asterisk. The law of effort versus result is one of Wyckoff's fundamental principles, stating that price should move proportionally to volume, which is a measure of the effort applied to the market. If the market shows significant effort expressed in high trading volume, for example on one or several consecutive bars, we expect a corresponding result, a significant price movement in the anticipated direction. However, if after great effort there is no corresponding result, or the price even moves against the expected direction, this is a powerful signal of hidden strength from the opposite side absorbing that effort. For example, if we see high volume on an upward bar but the price barely moves up, this could indicate active selling by large players who are absorbing buying pressure without significant price movement. The strategy involves setting a stop loss at a level that confirms the invalidation of the current trading hypothesis when a divergence between volume and price is observed. For instance, if you are in a long position and see high volume on an uptrend, but the price is not moving or even starting to fall, this could be a sign that smart money is selling, despite apparent demand. In such a case, the stop loss can be set below the low of that high volume bar that did not yield the expected result, or below the subsequent bar that confirms the weakness. This allows you to react quickly to a change in market dynamics, without waiting for the price to move a significant distance against your position, thereby preserving capital. The rationale for this strategy is that the absence of an expected result from significant effort is an early warning of a possible trend change, or that the market is in a phase that does not align with your hypothesis. This could indicate that large players who have significant influence on the market are acting against your direction, absorbing your efforts. Such a signal requires an immediate exit from the position, as holding on longer could lead to significant losses, as the market is likely to move in the opposite direction. Understanding this law allows a trader not only to avoid traps but also to identify potential reversals early, which is critically important for capital preservation and effective risk management. 8. Stop loss based on the break of test of key levels. After key events such as a spring, upthrust, selling climax, or buying climax, the market often returns to test these levels. A test is an important stage in Wyckoff's methodology that allows for the confirmation or refutation of previous signals regarding the dominance of supply or demand. A successful test in an accumulation phase, for example, after a spring, usually occurs on low volume, indicating a lack of supply after the shakeout of weak hands. This means that the bears no longer have the strength for further pressure, and the market is ready for an upturn. Similarly, a successful test in a distribution phase, for example, after an upthrust, occurs on low volume, indicating a lack of demand, pointing to the weakness of the bulls and readiness for a decline. The strategy for placing a stop-loss involves a clear reaction to a failed test. If the test of a key level fails, for example, the price breaks the low of the test in accumulation or the high of the test in distribution, especially if this occurs with high volume, this is a clear signal to place a stop-loss. For long positions, if after a spring test the price breaks its low again, this invalidates the accumulation hypothesis, as it shows that supply is still strong. For short positions, if after an upthrust test the price breaks its high again, this invalidates the distribution hypothesis, as it indicates the strength of demand. High volume on the break of a test level reinforces this signal, indicating active participation of large players in a direction opposite to your position, making the situation even more dangerous. The rationale for this strategy is that a failed test or a break of the test level indicates the persistence of pressure from the opposite side, which completely contradicts the initial hypothesis. This means that the initial hypothesis about the market's readiness to move in the expected direction proved incorrect. For example, if after a spring the price returns to the low of the test and breaks it with high volume, this indicates that supply is still strong, and the market is likely to continue its decline. Such a signal requires an immediate exit from the position, as it indicates a fundamental change in the balance of supply and demand that is not in your favor and could lead to significant losses. 9. Stop loss after a failed test of a broken level, back up to the edge of the creek, last point of supply. After the price successfully breaks a resistance level in an accumulation phase, often called a jump across the creek, it frequently returns to test this broken level. This level, which was previously resistance, should now act as support, confirming its change of role. This movement is called a backup to the edge of the creek, and it is important for confirming the strength of the trend. Similarly, in a distribution phase, after breaking a support level, the price may return to test this level, which should now act as resistance. This movement is known as the last point of supply. A successful test of these levels typically occurs on low volume, confirming the change in the level's role and the absence of significant opposing force. The strategy for placing a stop-loss for long positions, opened after a successful breakout and test, involves setting it slightly below the low of this test or back up to the edge of the creek. For short positions, the stop-loss is placed slightly above the high of the last point of supply. These levels are critically important because they confirm the effectiveness of the breakout and the change in the level's role. If the price successfully holds at this level, it is a strong confirmation of the new trend direction, and further movement can be expected. However, if it breaks through, it indicates the invalidation of the breakout and the market's inability to maintain the new direction, which is a clear signal to exit. The rationale for this strategy is that if the price breaks the test level and returns into the old trading range, this indicates the failure of the breakout and the invalidation of the initial trading idea. For example, in the case of a backup to the edge of the creek, if the price breaks the support level that was just resistance, it means that demand is insufficient to sustain the new uptrend. This could indicate a false breakout or that the market is still under supply pressure, and the composite man is not prepared to support the price further. Such a scenario requires an immediate closing of the position, as it signals a high probability of further movement against your position, which could lead to significant losses. 10. Dynamic stop loss based on change of character. Wyckoff's principles involve continuous analysis of the market's character, which is reflected in the sequence of highs and lows, as well as the strength and range of price movements. In an uptrend, the market consistently forms higher highs and higher lows, demonstrating the strength of demand. In a downtrend, it forms lower highs and lower lows, indicating the dominance of supply. A change in this character, for example, when an uptrend characterized by steady growth begins to form a lower high or a lower low, can be the first but very important signal of a potential trend change or reversal. This is called a change of character and is one of the most powerful early warnings of a shift in market dynamics and the loss of the dominant force. The dynamic stop-loss strategy involves moving it below the last formed higher lows for long positions, or above the last formed lower highs for short positions as the trend develops. This approach allows the trader to protect accumulated profits, enabling winning trades to run as long as the trend remains intact. However, as soon as the market shows the first logical signs of trend invalidation, that is, when the price breaks the last higher low in an uptrend or the last lower high in a downtrend, the stop loss is automatically triggered, exiting the trader from the position. This is a disciplined way to manage risks and profits, allowing for the maximization of potential gains and the minimization of losses. The rationale for this strategy is that a break of this level indicates a change in the market's character and a potential trend reversal. If an uptrend can no longer form higher lows, it means that demand is weakening and supply is beginning to dominate, changing the fundamental market dynamics. Similarly, if a downtrend can no longer form lower highs, it indicates a weakening of supply and a strengthening of demand. This method allows the trader to remain in a position as long as the trend is healthy and showing signs of continuation, but automatically exits them as soon as the market demonstrates the first signs of inability to continue the current movement. This is an effective way to protect profits and avoid significant losses when market dynamics change. The effective use of stop losses is not merely a technical requirement or an arbitrary rule, but a fundamental philosophy of risk management that underpins successful and stable trading. We have just examined 10 key strategies based on a deep understanding of Richard Wyckoff's market logic, one of the most influential analysts in history. These methods allow traders not only to limit potential losses, which is the primary objective, but also to consciously react to changes in market structure that signals the invalidation of the initial trading hypothesis. They enable one to see the market through the eyes of professional players, understanding their intentions and actions, which is key to forecasting future movements. Using these strategies helps avoid emotional decisions, which often lead to fatal trading errors, replacing them with a disciplined and logical approach. Emphasis on logic is central to Wyckoff's approach to trading. A stop loss, according to his principles, is not an arbitrary number set at a certain distance from entry or a percentage of capital. It is a logical line in the sand that defines the point where the initial trading hypothesis, based on a careful analysis of supply, demand, effort, and result, has proven incorrect. This is the place where the market clearly tells you that your forecast was wrong, and it is time to exit the position to avoid further losses. Understanding this logic allows a trader to act decisively and without hesitation, protecting their capital from further losses rather than hoping for a change in the situation. This transforms the stop loss into a powerful tool for capital preservation and the development of disciplined trading, which is a hallmark of a true professional. If you found value in these strategies and seek to expand your knowledge of trading, we have even more resources for you that will be indispensable in your development. Successful trading is continuous learning and adaptation, as well as understanding the deeper mechanisms that drive markets, and Wyckoff is just one of many sources of wisdom. That's why we created the Trading Insights channel. This is your guide to the world of professional trading strategies, methods, and principles used by specific traders, speculators, and investors from various eras and schools. Here you will find detailed case studies, interviews with experts, and practical advice that will help you develop your own effective trading system, tailored to your needs and style. Each episode of Trading Insights is a unique opportunity to look behind the scenes of successful trading operations and learn from the best, applying their experience to your own practice. And if you are interested in the deeper context of financial markets, their history and evolution, then the Wall Street Memoirs channel will be a real treasure trove for you. This is a fascinating journey through historical events, financial crises, and prominent figures of Wall Street who shaped the modern world of finance and investments. Understanding the past helps to better interpret the present and anticipate the future, as history often repeats itself. Wall Street Memoirs not only entertains but also provides valuable context for your trading activities, helping you avoid past mistakes and identify market cyclicality, which is an important element of strategic thinking. Subscribe to Trading Insights and Wall Street Memoirs today to not miss any valuable content and to gain a full spectrum of knowledge necessary for comprehensive trader development. Links to both channels can be found in the description below this video. Expand your horizons, learn from the best, and become a more knowledgeable and successful trader. This is your chance to gain a full spectrum of knowledge, from practical strategies to deep historical understanding, allowing you to make more informed and profitable decisions. We urge you to practice. Theoretical knowledge is important, but only applying it in practice transforms it into skill. Thorough study of market patterns, continuous practice of these stop-loss strategies in real or simulated markets, and adapting them to your own trading plans and unique market conditions. This is the path to true mastery. Remember that discipline and consistency are your best allies in long-term success. Always analyze the market from the perspective of supply and demand, and let Wyckoff's logic guide your stop-loss decisions. Your knowledge is your strength, and the deeper you understand the market, the more effectively you can manage it. Good luck in your trading.